Countries have different currencies due to their different economic environments. Having different currencies can be very advantageous because if one currency does lower in price, depending on how much trade and investing has been done with that currency, other currencies will not be directly affected. In this presentation, we'll be looking at the differences between two pairs of currencies and how they interact. We chose these currencies based on the familiarity we have with them, as well as the significant changes between the certain pair has in recent times. The first pair of currency we'll be looking at today will be between the euro and the British pound, as which Jamie will explain shortly how they interact with each other, especially since the Brexit vote on which the British public chose to leave the European Union. He will also be looking at the changes in interest rates on the currencies. After this, Constantine will be looking at how the Australian dollar and the US dollar interact with each other, comparing things like interest, and we'll also be discussing trade factors. But here first is Jamie discussing the differences between the euro and the British pound.
Hello, my name is Jamie and the pair of currencies that I'll be comparing and analysing today are the British pound or the GBP and the euro. To begin, according to exchangerates.org.uk, since the 26th of March 2016, the average £1 to euro exchange rate has fluctuated between 1.1524 to 1.3176 euros, with an average of 1.2278 euros per every £1. As of the 21st of September, the exchange rate of the pound to euro is 1.1648, a depreciation of the pound of 0.1528 with respect to the euro from its highest point in the last 6 months. According to the European Central Bank, interest rates have been placed at 0% and have been so since March 2016, making this quite a stable rate. I would suggest that there wouldn't be a change in this rate in the next few months if current trends continue. In comparison, according to the Bank of England, the current interest rate is at 0.5%, and with the United Kingdom having come to the decision to intend to leave the European Union as of June 2016, the immediate economic effects of this decision have now settled, and so we can expect rates to hold for the coming months. This would mean that as rates are higher in the UK, Europeans using the euro have the opportunity to invest and garner higher returns if they move their money into UK accounts. This leads to greater capital inflow for the United Kingdom, creating greater demand for the British pound. Greater demand of the currency will inevitably lead to the appreciation of the pound against the euro over the next few months. The average percentage of change of the Eurozone inflation rate per month in 2016 is at 0.00625%, according to statsbureau.com, with the most recent available figure being August's 0.09% increase. Since March of 2016, there has only been an overall increase of inflation totaling 0.1%, suggesting that inflation rates remain rather steady in the Eurozone. However, inflation rates have been very slowly declining since 2004. Bureau.com also suggests that in the UK, August's inflation rate increase of 0.3% combined with the overall total increase of inflation by 0.6% throughout 2016 suggests that the UK doesn't experience significant change either, but rather a similarly steady inflation rate to the Eurozone. Furthermore, since 2015, inflation rates in the UK have seen a slight upward trend in the opposite manner to the Eurozone. The Eurozone having a lower inflation rate would mean that their exports would have greater demand from the UK, and so a higher demand for the euro. It would also mean that the Eurozone would have lesser demand for imports and so less supply of the euro. So this means as the UK has a higher rate than the Eurozone, people from the UK will buy more products from the Eurozone. This will result in an appreciation of the euro against the GBP in the coming few months. Taking into consideration those factors affecting the exchange rates, there should be an appreciation of the GBP against the euro within the coming 3 to 6 month period.
Next up, Constantine will be discussing the differences between the US dollar and the Australian dollar and looking at macroeconomic factors such as interest rates, as well as trade factors into how they differ.
Hello, I'm Costa and I'll be taking you through an analysis and forecast of how the Australian dollar is trading against the US dollar. Over the past 5 years, the Australian dollar has depreciated against the US dollar. The chart from xe.com shows that from trading at near parity in 2012 and 2013, the Aussie has fallen to around 0.76 US dollars. Falling commodity prices, driven by slowing Chinese demand, have led to Australia's worsening in terms of trade. The recent spike in commodity prices, however, may assist in increasing the value of Australia's exports. According to the Australian Bureau of Statistics, the terms of trade has worsened by 5.4% in the year to June. Despite this, Quarter 2 for 2016 documented a 2% improvement in the index, aided by the increase in commodity prices, chiefly Brent oil. Overall, this suggests that export prices have risen slightly compared to import prices. Meanwhile, the United States is fluctuating around 100 on their terms of trade. This means that their import prices and export prices are relatively stable. Strengthening commodity prices and the modest improvement in the terms of trade index suggests that Australian export sector is headed into a slightly better period for performance. More foreign currency will be required to purchase goods made in Australia, and as a result, this will cause the Aussie to appreciate against the US dollar. Inflation in Australia has been very low in the last year. In the year to June, the Australian Bureau of Statistics reported only a 1% increase in the Consumer Price Index. The United States has also experienced stable prices during this period, reporting only a 1.1% increase in the CPI. While Australia's inflation rate has been on a declining trend, the United States has had modestly increasing inflation rates each year since 2014. As inflation rates have been fairly stable in these countries, we can expect these trends to continue. Moreover, so long as the United States has a higher rate of inflation than Australia, Australia's products will become cheaper to American consumers, whereas American-made goods will become more expensive in Australia. Thus, the expected inflation rate differentials will lead to an appreciation of the Aussie against the US dollar over the next few months. Another macroeconomic factor affecting exchange rates is the cash rate, or the official interest rate. Australia's official cash rate is 1.5%, as set by the Reserve Bank of Australia. Meanwhile, the United States has a lower official rate of 0.5%. Both the RBA and Federal Reserve set the cash rate to attempt to influence aggregate demand and price stability. Low inflationary pressures would suggest that these official rates won't be increased in the short term, but rather remain stable to encourage investment and growth in both countries. The difference between the cash rates represents an investment opportunity to American investors. With higher rates of return offered in Australia, they are likely to move their money into Australian bank accounts, thereby generating capital inflows for Australia and increasing the demand for the Australian dollar. This will put pressure on the Australian dollar and cause it to appreciate against the US dollar.
There are so many reasons as to why currencies can appreciate and depreciate against one another. Real-world events such as the Brexit vote can have massive effects on the evaluations of exchange rates. As Jamie mentioned previously, due to the euro having lower inflation rates and other factors, the British pound should appreciate against the euro. Oppositely though, because of high rates of return, as Constantine discussed previously, the Australian dollar will appreciate against the US dollar. The exchange rates will always be changing, and because of this, it is important to always look at real-world events to decide on where and how to invest in the future.